So far, we have been working to develop the ProForma statements, and we have done two of those. We developed the ProForma income statement. We used that along with some other material, including the capital budget, to develop the cash budget. And that leaves us really with the third item, development of the ProForma balance sheet. This ProForma balance sheet represents the cumulative changes we've had over time, and in order to develop this balance sheet, our starting point is going to be the prior period's balance sheet. Some of those accounts won't change, like common stock amount, but others will take on new values. In most cases, we've already developed the new values that will be required. And let's take a look at what that balance sheet might look like. This was our cash budget at the very bottom that we just developed, and all these various items that we developed over time in yellow, both here and when we were developing the income statement, we developed some things in yellow. So let's look at the balance sheet. On the left hand side, table 4-16, which conforms to the text, we have the balance sheet. You'll notice that it balances, which obviously every balance sheet should. Total assets of $50,000, total liabilities and equity of $50,000. The cash amount that we have initially of $5,000. If we go back, we would find that that matches up with our initial cash on the prior page. Beginning cash balance, way down here at the bottom, we had a beginning cash balance of $5,000. Marketable securities of $3,200. We haven't seen that before. That's a given. The accounts receivable were $9,600. If we went back to the development of that accounts receivable number, you recall we calculated the ending accounts receivable. We never calculated the beginning one, but we're collecting 80% every period, or in the subsequent period. In December, we had sold 12,000. 80% still needed to be collected. That 80% was collected, $9,600 in accounts receivable. Go back to the balance sheet. That's that $9,600. Likewise, our inventory number, which we developed in table 7. See an inventory number here of $4,960. Later on, it's going to change to $6,200. The plant and equipment, we're just assuming originally was $27,740, but we did add additional plant and equipment, which we saw, I'll highlight in blue at the bottom here. Additional plant and equipment we purchased, those were those two yellow numbers. We add all that up, we get total assets of $50,500. Our accounts payable initially, go back to that cash budget, was $4,500, which we purchased in December. We actually paid it off in January. So we have an account payable on the liability side. We didn't have any notes payable initially, which if we drop down here, perhaps I should take a moment to clean up. Okay, our note payable, initially we didn't have any, although we're going to have some at the end. Go back to the balance sheet. Long-term debt, we'll assume was $15,000. That hasn't changed. Common stock we'll assume is 10,500. That hasn't changed. And our retained earnings is was 20,500. That has changed because of our income statement. Recall from the income statement, retained earnings includes the income less the dividend amount. So we're going to end up with an increase in retained earnings of 18,524. So we pull all of that together. And so on the left we had our initial balance sheet. On the right we have our new balance sheet. The cash that we came up with in the cash budget, the cash at the end, is $5,000. The marketable securities is the same as it was before. Accounts receivable, we calculated the accounts receivable, we had 20,000 in sales in June, of which 20% was collected. That left us with 16,000 in accounts receivable. The inventory that we had left in table 4-7 was 6,200. That gave us current assets of 30,470, and then we had long-term assets or plant and equipment, which was our initial plant and equipment plus those two items, the $8,000 February purchase and $10,000 June purchase that we saw earlier. Let's go back and look at that. Those items. The accounts payable we calculated in table 413. Remember, we had materials that we're paying a month later on. The note payable was what we had to borrow to maintain our cash cushion. And then long-term debt and common stock didn't change. And retained earnings, our new retained earnings then, is the old retained earnings plus, so that's the old retained earnings plus net income minus dividends that we had earlier, and that's our new retained earnings. And we go through that whole process, and we are comforted to see, and one of the reasons it's important to go ahead all the way through to the balance sheet, it might be tempting to say, well, once I know what the cash flows need to be, why do I need to project a balance sheet? Well, one reason is because if the assets and the projection don't match the liabilities and equity, then something's wrong. Either you've left something out somewhere, or you've double counted something in some way. So that's a critical issue. Now, in this case, it's worth noting that our firm has actually grown, or we're projecting it to grow. It was 50,500 in assets. It now has 76,000. That's a substantial amount of growth in assets. How did we go about funding that? Well, we can actually answer that question. Let me clean up here. Let me actually pull some other materials up here. So we had a growth in assets to 76,000 from 50,500. That's a growth in assets of 25,640. How did we finance that growth? Well, some of it was financed by the increase in retained earnings that we had. So the increase in the balance asset side has to be matched by increase in the balance sheet side somewhere. So our retained earnings increased by 18,524. Our notes payable, they were zero to start with. Now they've grown to 5,884. And we also financed the growth partly by our suppliers. We increased accounts payable, so we just didn't pay our suppliers everything that we owed them along the way. we're a month in arrears there. And I don't mean that we're contractually late. We just have not paid for things that we've already received because we had terms apparently that allowed us to pay a month later. And we see the same thing happening there. So if we add up, and let me clean these up, remove those arrows. If we add up the various liability accounts, we find $25,640, which, not coincidentally at all, by design, is exactly the amount that our assets have grown. So we see where we can look here and see how we're planning to finance this growth. Some of it's through internal retention of earnings. Some of it's by borrowing from our suppliers. Some of it's by this note payable, presumably a bank note. We're going to borrow some from the bank. All of those together will be used to finance the growth in the assets. Let's do a quick review. In developing this ProForma balance sheet, we're going to use the prior balance sheet, which, to the extent we have unchanged items, they'll just be copied over into the new balance sheet. We've done a ProForma income statement analysis, which is going to give us the inventory and the retained earnings information. We had to develop the inventory information to develop that income statement. And the cash budget analysis is going to be used to develop the cash balance, so that we have our new cash balance, our new accounts receivable, because we need to calculate what we're going to collect to come up with that cash budget initially. We've included plant and equipment in that analysis, which will also be tracked into the balance sheet and added to the old balance sheet account amount. The accounts payable and notes payable are also from that cash budget. All of those come together to produce our ProForma balance sheet. Okay, we have now seen in those three statements the development of really three of the most important statements for financial forecasting. We forecast the income statement, we forecast the balance sheet. Those are statements that accountants after the fact are going to be quite interested in. This cash budget is something that's really of greatest importance in developing plans for accessing capital from our bank, or we might actually decide at some point we'd like to slow pay a vendor on a slower pace than we had in the past. At a minimum, we might contact a vendor and say, we're projecting in 4 months we're going to have a period when we need to borrow from the bank. We've been paying early. We've been meeting these earlier terms. These other months, for that 1 month, we might not. So there's no reason to be alarmed. And here are our projections as to why we're doing this, something of that sort. On the other hand, it might not be something you want to talk to your vendor about at all. They might get nervous. You might prefer to just talk to the bank about those issues and borrow money from the bank. So anyway, we've developed our ProForma statements, and that's the basic process that we need to go through in the development. It's complex. Obviously, there are a lot of steps involved. It's not that hard once you've done it a few times, but the first few times that you're involved in it, it's clearly going to be a little puzzling sometimes.